Hi, this is Todd Jordan, Managing Director with Hedgeye Risk Management, and today I have the privilege to turn the tables a little bit on our CEO, Keith McCullough. The impetus for this call is that Keith and I and many other members of the team typically talk about our institutional meetings. So Keith had a great day yesterday, I understand, with some institutional subscribers, and I wanted to get a little bit of some insight on what went on in those meetings. So Keith, I guess first, what were you pushing on these guys?
Well, as you know, like first we walk in there and we're pushing our own propaganda, we're pushing our own themes. So that's an important thing to do because we need to stress test these big macro themes that we fundamentally believe in. Now, if I walk into 8 meetings with institutional and some of the better institutional investors in New York City, I walk into their office and they just all disagree with me. That's either a really good thing or it's a really bad thing. Maybe a bad thing for our business, but a good thing like maybe I'm way outside of consensus.
Right.
So what we do, I usually go with the wood, I bring the big theme in, and our big theme is inflation accelerating. So I went into every meeting saying, hey, look, if you're not positioned for inflation accelerating, why? So try to prod and get some information as to what I might be missing, or moreover, what I might not be too hocked up about on inflation accelerating. And I actually came out of the day thinking that I wasn't worried enough about inflation. So that was an interesting kind of a takeaway.
So would you say out of the meetings you had, was it what, half agreed with you, half disagreed, or was it a market, you know, just as many on the buy side, just as many on the sell side?
Well, it's kind of inflation accelerating is an interesting one because obviously we've had deflation in commodity prices for 2.5 years. And anyone who would admit that they were long gold last year doesn't want to admit it because they would have gotten killed. So there's an interesting transition there. So once we started to talk about commodity inflation, it's easier to absorb that one. Because commodities are up 8% year to date, and oil looks like it's going to break out, and gold's been fantastic. But wage inflation, structural inflation, like on capital formation or fixed capital formation, labor shortages, there was a lot of good information out there, things that we hadn't done all the bottoms-up work on, that different customers were basically augmenting my thesis with new things that I hadn't considered. So that was a good thing. So I'd say that by and large, people aren't bullish enough on inflation. And there's probably a bigger and better case to be made for inflation.
Right. So if you go into one of these meetings, everybody agrees with you. It might be the right call, but there's no money to be made.
No, exactly. No, exactly. I mean, first of all, we know that the world is not bullish on inflation expectations. That's on the cover of The Economist. It says the perils of deflation.
Right.
So we know where consensus is. The question then is, where does the buy side go, and how much do they believe it? And again, I think that the buy side's just getting convinced that this is for real.
Yeah.
And that's an important tell.
Yeah, I have to admit, I'm, as you know, partial to this call because inflation expectations impacts the consumer, and I cover consumer stocks, gaming, lodging, and leisure. So I'm really in tune to what you're saying. But besides consumer, what are the other sectors, I guess, that will be hit really hard by that kind of thesis?
Well, part of it, part of it isn't that they're all going to get hit hard. I mean, you can invest in inflation, obviously. Yep. So, like, we're really bullish on energy, for example, really bullish on oil. That's a real bullish sector to be involved in. Actually, tech does pretty well when you get inflation accelerating like this.
But definitely bearish for consumer.
Oh, very bearish for consumer, potentially very bearish for financials. And it's very bearish for your short book if you have the same short book as last year. You know, if you're short gold, utilities, and REITs because you think that inflation's going lower, I mean, you're going to get killed. So there's a lot of setups there, I mean, to work with on this theme. That's why I like it so much.
Right, and it's contrasts a lot with what you had last year with growth accelerating for most of the year.
Right.
Which turned out to be dead on, right?
Yep.
Okay, so you're going to these
and
meetings.
And by the way, most buy-siders do, the one consensus is, if you're right and oil goes to 120, 130, that will slow growth. So the buy side believes fundamentally in what we're in reality. Whereas the sell side, or what you watch on TV or out of Washington, they're like, there's no inflation, it's never going to affect growth. So I think the buy side is always going to front run, that other edifice of consensus.
Oh, right. Well, the sell side's got a vested interest in letting the good times roll, where the buy side has to invest in reality.
Yeah, exactly.
Right?
Exactly.
So, okay, so you're pushing this theme, which is a very differentiated theme and a good one, and sounds like it's well researched. What are they coming back to you with?
Well, the biggest thing that they came back with that I hadn't really, or we haven't done enough work on, I think our financials team has done a lot of bottoms-up work on, the M&A cycle.
Okay.
Like almost every buy-sider out there can't believe that the acquirer is going up. So, Facebook buys WhatsApp and the thing, whatever it is, whatever that thing is, Facebook closes up on the day. But you could see some kind of mid-cycle industrial stock buys another one. You get some consolidation in the industry. Both stocks are up. So this is like a big theme on the buy side. It's also one of the main reasons where you could be wrong if you're bearish on the U.S. stock market overall. Because if you have to wake up every day to the next big deal, and both the acquired and the acquiree, or the acquirer and the acquiree, they both go up. I mean, what do you do in that environment? So that was constantly, every single meeting, 8 meetings in a row. That's what we talked about.
Could that be a sign of a top market peak, or is that just something that, but you just don't know if it's going to stay
No, you're
up
right.
there
I mean,
for a
because
while?
if all you do is live in fear of bad companies being acquired, I mean, what does that sound like? What year did that happen in? I mean, that happened in 2007. And it just because you live in fear that that's going to continue and continue and continue, it doesn't mean that it will. So it's an interesting one, and it's one that's developing. I don't think that it's one that potentially has legs forever, but it's an interesting one.
Are these guys investing actually with the theme that we should own some acquirers, companies that have good balance sheets with a lot of capital?
Yeah.
Because we think now they're going to go up when they buy something, and money's so cheap, so everything's accretive that they buy.
Yeah.
If they're using cash.
Yeah, I mean, and again, to be clear, we're talking about some of the best performing fund managers on the planet. The guys that didn't lose money in the down moves, that have been very strong on some of these up moves. Some really sophisticated investors will say, yeah, I'm looking at this company. It trades at 8 to 10 times earnings on margins that I think can go up 20 to 30%. And they're going to go buy their poorly managed competitor, create some consolidation in the sector, and I'm going to own them both. So I heard that a couple times from some of the smartest people. If I could tell you who they were, people would go, wow, yeah, that makes a ton of sense. Particularly in technology. There was a lot of talk about that, and also in energy.
So what do these guys do? Because some of these, or most of them maybe, were long-short type funds that you met with, right? So what are these guys doing that are actually good short sellers in this kind of market? How do they manage that?
Exactly. Well, one who's probably one of the more famous short sellers, he basically said, so what do I do when all my shorts go up every day? Yeah. And he's just kind of like mocking himself at some point, because again, he's like, I'm short a company that trades at 18 times revenues, and there was no catalyst, but the stock's up like 3% on a sell-side upgrade. And again, there's almost like I don't know, a tone of exasperation in that. And you typically will get that kind of a feeling. Like obviously, some of these shorts of his are going to work, but when they're not going to work, the last couple days when they're not going to work is when he's going to probably feel the most exasperated. Like it's almost like he's mocking himself. And I think that that's an interesting one too. I mean, we've seen high multiple, high short interest stocks just go parabolic in the last 3 to 4 trading days. And again, that's largely a function of people just saying, look, nothing's ever going to go down again, which is a pretty good sign that things will probably start to go down again.
Right. So how are the long-only guys looking at your thesis?
Well, I had a couple long-only guys that were mocking, the valuations on their longs. I mean, it was kind of interesting where the guy, again, he's like, well, the thing is actually implying 20 times revenues. I haven't actually owned anything that's traded 20 times revenue. He's like, that's cool. I got to figure out, when to start selling some though, because if this ever stops, I'm going to be in some trouble.
Right, but he still owns it.
Yeah, they're in the business of being long growth. I mean, and being long growth stocks that can deliver on growth expectations for the last 15 months has probably been one of the best strategies possible. Now, don't forget that earnings growth are a lagging indicator. So the last, let's say that all these great growth companies are printing peak of their growth sequential kind of metrics this quarter. You should see them kind of do this vertical move and then potentially start to go down after that. So there's definitely some concern out there. One of the main concerns that they always say is, like, give me timing. Like when does this stuff stop going down? So the guy who's short it wants to know, and so does the guy who's long it. Because the guy who's long it's got to sell some, and the guy who's short it doesn't want to get stabbed anymore in the earlobes with this kind of stuff. So my answer is simple. As soon as the street realizes that inflation is stronger than expected and growth is slower than expected, so in other words, when GDP gets cut in half from 4 to 2, and inflation goes from 1 to 2, it doubles, that's when you're going to get paid on the short side, and that's when you want to definitely have it lightened up on some of these parabolic moves on the long side.
Now, long-only guy, you may be recommending a little sector rotation then out of these consumer stocks into energy stocks, into tech possibly, which is, I would say that's probably a differentiated call right there.
And again, some people say, oh, it's long-only. Long-onlys are sharp. I mean, they've been in particular, some of these firms, they've run long-only businesses since the mid-1960s. They've seen bear markets. They've seen bull markets. So a long-only guy knows who's good, not some guy who's just chasing beta. I mean, somebody who's like legitimately good, generates consistent alpha. What does he do when he thinks that market's going to start to turn? He'll rotate, exactly. Like he'll do basically what you just asked. So I wouldn't be surprised to see people move into energy in a much more meaningful way. Energy's cheaper, it's under-owned, there's bigger caps where they can go hide. You know, that's a place where I'm pretty sure if I'm right on inflation accelerating, that's where people are going to rotate out of, you know, some of this, particularly some of the high-value consumer stocks.
Now, last question for you. Do we see the sector rotation and the market start to move down before we get the data coming in that inflation is actually accelerating, consumption is under pressure?
Well, that's, I mean, one, that's already happening, actually. So you see, like, from a year-to-date perspective. First of all, like, you got to go through the year-to-date and understand the buy-side psyche. Everyone on the buy-side comes in long on January 1st. Market's at an all-time high. It goes down 5% in a straight line.
Right.
So the first month is straight down. The second month is straight up. So there's like a perfect V of the market. But within the V, which, you know, creates a lot of consternation and emotional issues, obviously, but utilities have been straight up.
Yep.
Utilities, healthcare, 6-7% up year to date. The S&P's flat. Consumers down already 3%. So I'm already starting to see it. So I think that that's why, and the market's already starting to see it. If you just wake up in the morning and say, well, what's the stock market doing? It's up. I mean, you're completely blind, dumb, and stupid. I mean, you have no idea. But the buy side definitely understands that, and I think that that's what's got them much more convinced that inflation in particular could slow consumption growth.
Great. Well, that's good, and it's always good these meetings because not only you're giving some, you're getting some back, and you get a good feel for what.
A ton of that. I sit and as you know, so do you. You do this. I mean, we have a very, I would say, privileged position to have customers trust us with their research. And
great customers, too.
Yeah, and you go back and forth and you have very solid debate, and it just makes us, you know, certainly makes me less dumb, which I need.
Excellent. All right, well, thanks, Keith. We appreciate it. And thanks, everybody, for joining us. I hope you enjoyed a little bit of insight into some of our meetings with our institutional subscribers. Again, I'm Todd Jordan, Managing Director with Hedgeye Risk Management. This was Keith McCullough. And if you have any questions, please tweet us, Keith McCullough, or @Hedgeye.